Welcome to the award-winning Consumer Finance Monitor podcast, where we explore important new developments in the world of consumer financial services and what they mean for your business, your customers, and the industry. This is a weekly show brought to you by the Consumer Financial Services Group at the Ballard Spahr Law Firm. And I'm your host, Alan Kaplinski, the former practice group leader for 25 years and now senior counsel of the Consumer Financial Services Group at Ballard Spahr. And I'm pleased to be moderating today's program. For those of you who want even more information, don't forget about our blog, consumerfinancemonitor.com. Yes, it goes by the same name as our podcast show. We've hosted our blog since 2011 when the CFPB became operational. So there's a lot of relevant industry content there. And we cover a lot more than the CFPB, as you will see from our program today. We also regularly host webinars on subjects of interest to those in the industry. So to subscribe to our blog or to get on the list for our webinars, please visit us at ballardspahr.com. And if you like our podcast, please let us know about it. You can leave us a review on Apple Podcasts, YouTube, Spotify, or wherever you obtain your podcasts. Also, please let us know if you have any ideas for other topics that we should consider covering or speakers that we should consider as guests on our show. I'm going to take a moment to toot the horn of our podcast show. I'm very proud to report that a company called Million Podcasts, which is a podcast database service, has ranked our Consumer Finance Monitor podcast in the top 25 in the country among hundreds of financial services podcasts. The service recently published a list of the top 100 financial services podcasts in the country. Our Consumer Finance Monitor podcast also ranks as the top law firm podcast among the top 100 financial services podcasts, as well as the only one focused on consumer financial services. Million Podcasts ranks podcasts across industries based on key factors such as review count and ratings, topic relevancy, consistency of fresh episodes, and a total number of podcasts. For its rankings, Million Podcasts leverages its extensive database of more than 2.5 million podcasts from various industries. So let me tell you a little bit about our program today. Our program today is a repurposed webinar that we conducted on May 13th. The topic of the webinar and the topic, of course, of our podcast show today is what is happening at the federal agencies other than the CFPB that is relevant to the consumer financial services industry. We figured we spent a lot of time covering the CFPB, and it was about time to devote some attention to all the things that are going on at the other agencies, the Federal Trade Commission, the Comptroller of the Currency, the FDIC, every agency except for the CFPB, which of course we will continue to cover and monitor, but not today. Today the focus is on the other agencies. And what we're going to be talking about are strategic priorities of the other agencies, the importance of the removal of the two Democratic members of the Federal Trade Commission, leaving only 3 Republican members to manage that agency. The status of final and proposed rules of the other agencies. The effect of agency staff cuts, including reductions in force. Enforcement investigations and litigation. The elimination of reputational risk by the OCC and the FDIC as a criterion for evaluating performance of those agencies. The topic of debanking and fair access, fair lending enforcement, federal preemption, including the 3 cases that are still percolating in the First Circuit and in the Ninth Circuit regarding national bank preemption, related to the question of whether those banks must follow state law and pay interest on mortgage escrow accounts. And we'll also be talking about a very important case in the 10th Circuit Court of Appeals pertaining to state charter banks and their ability to continue to export interest into the state of Colorado from a state where rates have been deregulated, even though Colorado has opted out of DIDMCA, which is the 1980 statute that purported to confer usury parity on state banks with national banks. And then we will talk about the plethora of President Trump's executive orders, some of which pertain very directly to all of these agencies, including the CFPB, which essentially gives the president the power to decide every action of importance taken by the agencies, promulgation of regulations, elimination of regulations, et cetera, et cetera. So now at this point, I'm going to go right into our webinar. Today's speakers for the program. So we've got Scott Coleman, who is principally focuses on what I would call traditional banking law, bank M&A, and bank structure, and banks selling branches and doing a variety of other things. And Scott's also, among other things, an expert on the Community Reinvestment Act. So we've got Scott joining us. We have Kristen Larson. Kristen has been a member of our Consumer Financial Services Group for almost 3 years. And she truly is conversant in all areas of consumer financial services. And last but not least, I want to introduce Ron Vasky. And Ron Vasky, like Kristen, also very, very knowledgeable about consumer financial services. And in addition to giving regulatory advice, Ron very often is involved in structuring a wide variety of transactions involving payment systems and artificial intelligence, etc. So the way we are going to work today is I'm going to turn the program over to Scott, who's going to first talk about strategic priorities of the federal banking agencies. And here is the agenda slide to give you just a very quick overview of what we're going to be covering today. And you can see we're going to cover a lot. Everybody is so focused on the CFPB that it's very easy to lose track of what's going on at the federal banking agencies and the FTC and the Department of Justice, et cetera. But today we're going to help fill what might be an educational void for you. So, Scott, why don't you take it away and tell us what's happening at the federal banking agencies?
Thank you, Alan, and good morning and good afternoon to everyone. We'll start first on the concept of cryptocurrency. We have already heard a lot about the receptivity to crypto activities in the federal government generally, and certainly the bank regulators are heavily involved in that. First of all, the OCC on March 7th issued an interpretive letter withdrawing from two prior interagency statements on crypto activities and reaffirming a prior issuance. So for the OCC, they had previously determined that it was possible for financial institutions, for national banks in particular, to engage in mobile wallets involving crypto, to involve custody of crypto assets, including stablecoins, and had allowed operation of independent nodes in the crypto space. And then during the Biden administration, all of that was put on hold generally, and the OCC, FDIC, and Fed adopted a joint interagency policy statement, which basically said for financial institutions, you've got to consult with your regulator before you can engage in any of these activities. So the OCC letter removed the OCC from the interagency statement, and they issued an interpretive letter 1184 that confirmed the ability of national banks to engage in custody activities. The FDIC followed in tandem. In March 28th, they issued a financial institution letter that provided new guidance for FDIC supervised institutions that seek to engage in either of those activities: custody, noting, mobile wallets, etc. And they withdrew from the joint interagency statements on April 24th. The Fed, a little later, followed through and rescinded a 2022 supervisory letter that required advance notification for crypto asset activities, and a 2023 supervisory letter regarding the non-objection process for state banks engaged in those activities. The Department of Justice also in April issued a memo that outlined a new policy direction for the DOJ regarding the enforcement of laws related to digital assets. This isn't to say that those do not create application issues and supervisory issues, particularly Bank Secrecy Act issues that will be scrutinized, but the framework where you must seek consent first and consult with the agency to receive non-objection has gone by the wayside. The OCC has announced a number of changes in its strategic priorities regarding the regulation of national banks. It's restructuring itself. It is setting new priorities focused on reducing regulatory burden, changing their approach to promote financial inclusion, being more willing to accept and embrace bank-fintech partnerships. And we'll see this from the FDIC as well. But if we looked at what happened during the Biden administration from the prudential regulators regarding bank and fintech partnerships, by and large, there were a rash of enforcement actions from affecting institutions that adopted banking as a service, as a business plan. It was very dangerous to head down that road without proper safeguards and controls and without a lot of consulting and handholding with the regulators. They are now, at least at the OCC level, more willing to look at bank and fintech partnerships, and we'll talk a little about that later. As we said, expanding responsible bank activities involving digital assets and supporting banks that wish to explore those technologies. They also withdrew principles for climate-related financial risk management, and we talk a little more about that on this slide. And we've seen more application activity from the OCC as well. They approved the Capital One acquisition of Discover Bank. That approval, proceeded with, given its size, more pace than we might have seen under the prior administration. And it's at least an early indication that they're more receptive to bank acquisitions. The second transaction that is noted on this slide is a transaction I know well since I represented the target bank. A fintech lender in the small business lending space called SmartBiz acquired SunTrust Bank and adopted a new business plan to operate on a national basis. That transaction took an extended period of time. The agreement had originally been signed in 2023. The application process took well over a year, but coinciding with the change in the administration, we saw quick approval and a closing this spring. The FDIC has issued a press release back in January setting forth its strategic priorities in 2025, which includes a review of regulations, guidance, and manual to promote the economy, to adopt, similar to the OCC, a more open-minded approach to innovation and technology. They're more willing to accept banking as a service business plans and bank and fintech partnerships. They withdrew the 2024 statement of policy on bank mergers. They have withdrawn the broker deposit policies and proposed regulations on corporate governance. They're focusing more on core financial risks and less on process. They are going to look at the resolution process following the large bank failures in 2023. They're still examining capital and liquidity rules to make sure that there's a balance in driving economic growth with safety and soundness. They've indicated a desire to encourage more de novo activity. We'll have to see if that will involve a lowering of the capital requirements for a de novo, but that would be a positive because there have been a dearth of those in the system. They are promoting access to financial institutions across the country, including those that are seeing consolidation, reduced opportunities to access financial services. The FDIC proposes to modernize the implementation of the Bank Secrecy Act. They're going to study deposit behavior, reevaluate disclosure practices, and pursue internal efficiencies to protect the Deposit Insurance Fund.
For the NCUA, their priorities are similar to some of the other agencies. In particular, they're going to focus on credit risk, and part of this is due to the 2024 increase we saw in delinquencies and charge-offs, especially in credit card portfolios and auto finance on used loans. And so they'll be looking for sufficiency of loan underwriting standards, some of the allowances for credit losses, reserves, charge-off practices, management of third parties. In terms of the balance sheet, what their concern is there's the rising interest rate environment, and that's increased some credit unions' cost of funds faster than the return that they're receiving loans or other investments, which essentially is squeezing their net margin, putting pressure on their earnings. And so they're going to pay more attention to credit liquidity and market risk and weigh the sources of earnings and the net worth relative to the credit union's plans and thresholds. Cybersecurity is going to continue to be a focus, especially in light of the numerous breaches we read about every day, and they're continuing to offer tools for credit unions to assess their cybersecurity maturity. In terms of consumer financial protection, they still want to focus on certain areas. With respect to overdraft programs, they say that they're still going to review overdraft programs, your policies, procedures, disclosures, fees, statements, complaints, websites. One of the things that they did change, though, was in March, they announced that they're no longer going to require the publishing of overdraft and NSF fees income for individual credit unions. They'll still publish it and collect it at an aggregate level, but there'll be no calling it out on an institution level. With respect to fair lending, examiners will assess the policies for identifying and mitigating discrimination in residential real estate. valuations. For home mortgage, Disclosure Act, they're really going to look at compliance with the law and regulation, looking at some of the reporting policies and practices, including transaction testing, and looking at credit unions that are reporting above the threshold. Military Lending Act will continue to be a priority. We've seen this through all the different agencies. They're going to ensure that credit unions are complying with MLA and making sure they have the proper policies and procedures and compliance management systems in place. With respect to electronic fund transfer and Reg E, they will continue to look at how credit unions are handling payments and error resolution. Some of the other updates they made are related to exam flexibility. They've extended some exam cycles for certain credit unions, and so that may help. And they also are, kind of looking at fundamental controls that credit unions have, as well as AML and BSA compliance. One of the things that Chairman Helpman has also discussed is what he calls true financial inclusion. And he's trying to remove some of the barriers to de novo credit unions and some of the pain points that have led to fewer credit unions. And with that, I'll turn it over to Alan to talk about the FTC's strategic priorities.
Thank you, Kristen. I guess the only other thing I would add to NCUA is that the whole credit union industry, their probably top priority is to be able to retain the federal income tax exemption that they've had, I think, forever. And they are, once again, the banking industry is lobbying very hard to get that eliminated. But anyway, turning now to the FTC strategic priorities, it's very interesting that if you were to do a search, a Google search of FTC strategic priorities, the main thing that you would pull up would be a strategic priority plan that was released in 2022, covering the years 2022 through 2026. And of course, in 2022, the agency was controlled by the Biden administration, the Democrats. There were 3 Democrats and 2 Republicans on the Federal Trade Commission. And at that point, I guess they were very optimistic that the Democrats would continue to control the White House after the time of the last election. So I think I wouldn't spend a lot of time looking at that document. I think it's largely outdated. But let me make a couple of observations at the beginning before touching on a few things. And that is, compared to what's going on at the CFPB, in terms of the attention that's been focused on the CFPB, practically from the time that President Trump was inaugurated on January 20th, but really picking up steam after he fired Rohit Chopra and DOJ got involved, and there were 2 acting directors, first Scott Bessent and more recently Russell Vought, particularly Russell Vought. There has been incredible attention paid to the CFPB. Other than, and this is a big exception, of course, that I'm going to talk about in a minute, the fact that Trump did fire the 2 Democratic commissioners that had been on the commission for a while. He fired them without cause, so that now the FTC is controlled by 3 Republican commissioners, which is contrary to the intent of Congress. Congress intended that there be a bipartisan commission with control being, namely the commissioner, being from the party of the president. But the fact is that of those 3 commissioners, 2 of them have served for quite some time when the Democrats were in control of the FTC. And I don't know whether it's the particular Republicans involved right now or the fact that they're used to compromise. That is, talking to people who are on the other side of the aisle. And they, if you go back and you look at the number of dissents that the Republicans had to enforcement matters, there are some for sure, not as many as you would think. And therefore, I'm not going to say it's going to be business as usual at the FTC. That's certainly not the case. But they are not by any means, there is no attempt to get rid of the FTC, to minimalize it in the way that they have minimalized the CFPB. Particularly they have a dual mandate at the Federal Trade Commission. One is antitrust laws, and I would say that's the area where there are going to be the fewest changes. The FTC sued technology companies under the Biden era, and those lawsuits continue under the Trump era. So there seems to be broad bipartisan support for enforcing the antitrust laws against technology companies, particularly large technology companies. In terms of the consumer agenda, which is, of course, of the greatest interest to us that practice in the consumer financial services area, I guess I would say the document I would recommend that you take a close look at is mentioned in the second bullet point, a keynote address that was given by Melissa Hoyok at the International Association of Privacy Professionals Global Privacy Summit. Now, that's a mouthful for sure. But she laid out 3 top priorities, and most of them really focused on data privacy, the regulation of AI technology. That doesn't mean, I don't think it means a very close scrutinization of AI to determine whether it has a discriminatory effect on a particular class. I don't think they're going to be focused on that. They're going to be focused on, how AI technology, if people are using it to commit out and out fraud, they'll be very focused on that. Boosting protections for children and teens online, for sure. They are very committed to that. And also strengthening enforcement against companies that sell, transfer, disclose geolocation information and other sensitive data to foreign adversaries. And indeed, they will work with the Department of Justice on that. That is a priority of DOJ. So if we say we expect a shift from consumer protection to antitrust, clearly it's going to be more oriented around antitrust enforcement than consumer protection. But consumer protection is not going to go away. There already have been enforcement actions that are brought. There will be others. They have downsized the agency, but they haven't done to the FTC what has happened to the CFPB. So let me turn now to what I referred to just a little bit earlier about what has happened at the Federal Trade Commission that is very significant in terms of governance of the FTC and governments of a number of federal agencies that are structured in a similar manner. That is, they either have a 3-member board or a 5-member board, and it's supposed to be bipartisan. And typically, you can't, if you look at the statute, and in this case, the Federal Trade Commission Act, you will see in the statute that a FTC commissioner can be removed by the president, but there has to be cause. It can't be fired like President Trump fired the two Democratic commissioners. Let me give you just a quick overview, this slide, of what law is going to be applicable here, because this issue is unquestionably headed for resolution by the U.S. Supreme Court, and the implications for federal agencies, including the Federal Reserve Board. And that could have an impact on whether or not Jay Powell, the chairman of the Fed, really will be able to serve out the remainder of his term as chairman until, I think, May of next year. The Supreme Court comes down with an opinion that is broad enough to give the president the power to get rid of agency members without cause. Then the issue will be whether the Federal Reserve Board can be distinguished from that precedent. But anyway, the key issue is whether or not an old 1935 case that was decided by the Supreme Court involving the very same Federal Trade Commission, whether that case will be upheld by the Supreme Court as it considers these new firings that have occurred, or whether it will be overturned, or whether it will be distinguished, as it was distinguished back in 2020 when the Supreme Court held that the president had the right to remove the sole director of the CFPB without cause. And that opinion was based on the constitutional theory of separation of powers, that you can't limit if an agency is performing executive functions, that agency, in a sense, really can't remain independent. It's got to be subject to presidential fiat. Well, in any event, you've got the Humphreys executor case, which struck down President Roosevelt's attempt to terminate FTC Commissioner William Humphrey. And the court made an exception in that case and said that the for-cause removal provision was constitutional, did not run afoul of separation of powers. And that was because it was predominantly quasi-judicial and a quasi-legislative body with little focus on enforcement, typically reserved for the executive branch. Well, that was 1935, and the powers of the FTC have expanded since that time. So they're going to take a fresh look at that case. I have no doubt about it. And I would not be surprised at all if it got overturned. We already know there are at least two members of the Supreme Court who wanted to overturn Humphrey's executor when it came down to the seal of law case, but decided they didn't have to go there because they were able to distinguish seal of law based on the fact that there was sole director and Humphrey's executor involved a 5-member commission. So let me go to the next slide. On this slide, this features the cases that are outstanding right now. Before President Trump terminated the two Democratic commissioners of the FTC, he had previously fired Kathy Harris, the chairwoman of the Merit Systems Protection Board, and Gwynne Wilcox, a member of the NLRB. They both sued. They won in the district court. They won in the Court of Appeals, with both the district court and the Court of Appeals correctly relying on the language in the relevant statutes and the Humphreys executor opinion. On April 9th, Chief Justice Roberts issued a temporary stay of the decision involving Harris and Wilcox, and it's all one case. They were co-plaintiffs, pending further order of the court. And that case has been briefed, and we're now waiting for an oral argument. to be set, not on a petition for a writ of certiorari, but rather on a different docket of the Supreme Court where a stay is being sought. Now, let me go to the final slide, which talks about the FTC and the NCUA. As I mentioned, the FTC commissioners Slaughter and Bedoya were fired by Trump. That happened a little while after the other firings had occurred. And they sued the president and the administration in court. And the case is now has been briefed on cross motions for summary judgment. Both sides have filed for summary judgment. They did not seek to seek injunctive relief, preliminary injunctive relief. Instead, they went right to the summary judgment phase of the case. And a hearing is scheduled in the district court for May 20th. So that's coming up very soon. Finally, the two Democratic NCUA board members were also fired by President Trump shortly after he got rid of the Democrats on the FTC. And they sued as well. And they have not got as strong a case, at least that's my opinion, because there is no language in the Federal Credit Union Act, this language I could find, that says you can only remove an NCUA member for cause. It doesn't say anything. It's silent on the issue. But the conventional wisdom has always been that the president can only remove a member of the NCUA board for cause. Also, what you have right now is just a peculiar situation in NCUA where you have one board member, that's all they have, who's a Republican. And the question is that what that one board member does, is any of his actions legitimate? Well, I don't know. There's some language in the Federal Credit Union Act that suggests that you got to have more than one board member, but yet the NCUA has previously purported to govern itself with one board member. So we'll have to see about that. Let me now turn the program back over to Scott, who is going to, here we have a check the box, make sure you're still listening. And I'm turning it over to Scott to talk about the House Financial Services Committee request letters.
Thank you, Alan. And I'll go through some of this rather quickly because it dovetails with some of the agency priorities we've already talked about. But the House Financial Services Committee Chair, French Hill, is a former banker himself and is very pro-community banking. And so has been very active writing letters to the regulators requesting specific policies be focused on. The first was a joint letter to the Federal Reserve Board, the FDIC, and the OCC regarding rescinding final rules, withdrawing proposed rules, or substantially revising guidance issued during the Biden administration. And by and large, you will see that the House Financial Services Committee's objectives have been granted. They sought withdrawal of the CRA final rule. They sought repeal of a joint notice of proposed rulemaking revising capital requirements on institutions and long-term debt requirements for large institutions. They sought to seek withdrawal of guidance on climate-related financial risks. And as I've talked about, managing risks with third-party relationships. On March 31st, there was also a joint letter regarding digital assets and crypto activities, requesting withdrawal of the FDIC and Federal Reserve Bank agency guidance and applauding the OCC that had already withdrew prior guidance at that time. Remember, the OCC took action on March 7th. They asked that the FDIC financial institution letter that required FDIC supervised institutions to notify the FDIC of their plans be withdrawn. And they proposed to ask the Federal Reserve Board to withdraw supervisory releases that they felt imposed unnecessary supervisory burdens on the use of distributed ledger technology. They, applauded the OCC, as we mentioned, for reinstating prior guidance on what is permissible from a digital assets standpoint. They wrote a letter to the Fed requesting the proposed rules be withdrawn or guidance rescinded, including the surcharge for globally systemically important banks, proposed rule regulation II to lower debt intercard relationships, and requested climate risk management practices guidance be withdrawn, and that a financial institution letter regarding the process for Bank Merger Act implications also be withdrawn. On March 28th, they wrote a letter to the OCC asking that the OCC rescind their final policy statement on bank merger transactions. And they wrote a letter to the Department of Treasury rescinding Financial Stability Oversight Council guidance on the determination process for designating non-bank financial companies as systemically significant and seeking a new framework for promoting financial stability. They also wrote a letter to the FDIC commending the withdrawal of the 2024 Statement of Policy on Bank Merger Act transactions, withdrawing the proposed rule on broker deposits, withdrawing a proposal the FDIC had made to require the filing of a Change in Bank Control Act notice, even when another agency was processing a Change in Bank Control Act notice for the same control relationship, commending the FDIC for the withdrawal of a proposed rule on corporate governance standards and on incentive-based compensation arrangements, and extending the compliance dates for FDIC signage rule updates. They proposed rescinding or significantly modifying final rules or guidance, including a 2012 rule on resolution plans, the proposed rule regarding deposit insurance record keeping for financial institutions, proposed rule for the parent company of of industrial banks and industrial loan companies. So that rule was intended to primarily put industrial bank holding companies under a similar framework of review that bank holding companies and financial holding companies go under. Again, they wanted to see guidance on the resolution planning processes of large banks be withdrawn, and wanted to seek supervisory guidance on representment fees to be withdrawn as well. As mentioned, there has been changes regarding the Community Reinvestment Act. It's been quite a roller coaster for Community Reinvestment Act compliance, especially for national banks. The OCC had previously, during the last Trump administration, gone it alone and adopted a CRA modernization rule that would only impact national banks. That was subsequently, during the Biden administration, withdrawn, and a new rule was adopted jointly by the Fed, by the FDIC, and the OCC. That rule went much further than the OCC rule had in determining assessment areas, determining compliance activities, looking at CRA lending and CRA investments, and required, especially for larger institutions, significant data reporting and data gathering. That process has been in place for a while and is now withdrawn. So any action taken by the financial institutions in compliance with the rescinded rule, we're back to square one. We're back to a rule that has not been updated since 1995 and doesn't really reflect how financial institutions service communities and designate communities today. We're still in need of Community Reinvestment Act modernization at some form, even if it was similar to what the OCC had previously proposed. Whether we'll see it or not in the current administration is questionable at this point in time.
Next, we're going to talk about the status of some of the rules that are out there. The first rule was the CARS rule that came out This rule has been vacated by the Fifth Circuit. So we'll see what happens there. Prior to the Fifth Circuit vacating it, the FTC actually issued a stay on the effective date. So the next rule that we want to talk about is the negative option final rule. This is the click to cancel rule. And so part of the rule already went into effect, and that was in January. And that was related to the part of the rule that said a seller cannot misrepresent expressly or by implication any material fact, including the negative option feature, the consumer consent deadline to prevent or stop a change or cancellation of a negative option feature, the cost, the purpose, or efficacy of the good or service, health or safety, or any other material fact. And so that's gone into effect. What has been delayed and just was recently delayed further till July 14th is the rest of the negative option rule, which requires specific disclosures, consents, and cancellation provisions. Now, this has been challenged in the Eighth Circuit. And interesting enough, which we haven't seen in a lot of these other cases, is the FTC filed a brief defending the rule. Essentially, they're challenging the argument, saying that there's nothing in the law that prohibits the FTC from using its rulemaking authority to promulgate cross-industry rules, and that it's been doing it for decades, and it's cited to the mail order rule, the franchise rule, and also the holder rule. And so we'll have to see what happens. It's interesting that they did the delay to July. It kind of corresponds with the timing of California's similar automatic renewal law that becomes effective on July 1st. So that may be why, but we're waiting to see whether the Eighth Circuit will rule on this prior to July 14th. Again, they declined to issue the stay for the misrepresentation part of the rule that became effective in January. But yeah, it's fully briefed, and we'll wait and see what happens out of that. But if they don't act, I guess we have to prepare for the rest of it to be effective by July 14th. And obviously that means continuing to work on disclosures, consents, and cancellation provisions so that everyone is ready for it. The FTC also has the junk fees final rule. And so this was the rule that came out and was effective yesterday. Essentially, there really isn't any legal challenges that I'm aware of. It applies to businesses selling live event tickets and short-term lodging. And live event tickets are like concerts, sporting events, music, theater, live performance. Short-term lodging is temporary sleeping accommodations at a hotel, motel, inn, short-term rental, vacation rental, lodging. It would include like an Airbnb or a VRBO or discounted extended stays at a hotel. And it's going to apply to both businesses and consumers. And essentially what it wants you to do is to display the total price. Now, this is a rule that makes me happy. My daughter was purchasing concert tickets, and I said, well, what's the total price? And she kept saying a number. I'm like, no, I want to know all the prices with the fees. Tell me the full price. But she assured me that that was the full price. And it's what I was charged in my card. So I was happy to see that. And so we don't think this, unlike some of the other junk fee rules, this continues to be something that the current administration does not like. And so we don't expect that there's going to be a pivot on these in the near future. The FTC just recently announced a rule banning non-competes. Essentially, they're saying that it's an unfair method of competition and a violation of Section 5 of the FTC Act for employers to enter into non-competes with their workers and to actually enforce them. Under the new rule, if you have an existing non-compete, it's not going to be enforceable. There is an exception for senior executives under the final rule, but the employers won't be able to enter into any new non-competes, even if it does involve a senior executives. And they'll be required to give notice to their workers other than senior executives who are bound by an existing non-compete that they will not be enforcing them against them. So this is a dramatic change, which we think will have impact throughout the industry. Next, I'm going to switch to the FDIC. As most are aware, the FDIC had made changes to its advertisement rules. It allows institutions to say like FDIC insured instead of member of FDIC or member FDIC, which were the former terms that could be used. And so it gives some flexibility for some of the signage. And the signs that are like within the institution's premises have gone into effect. What has been delayed are some of the signs that you have to display on digital and ATM channels. And so they've asked for this delay, and the FDIC says they're going to develop proposed changes to the regulation to address some of the implementation concerns and confusion that they're hearing from the industry. But again, the part of it already is effective, but the rest is going to be delayed till March 1 of 2026. And as Scott mentioned earlier, there was, pressure from the House committee, but some of the agencies have reacted. And so the FDIC has proposed or has withdrawn certain proposed rules, broker deposits, guidelines for establishing standards for corporate governance and risk management, regulations implementing changes in Bank Control Act, regulations related to incentive-based compensation. They also have taken action on bank merger transactions and proposed rescinding a 2024 statement of policy and looking to reinstate on an interim basis what was in place before 2024. And they're looking for public comment on that and, what they should do on a longer term basis. And they've also modified their approach to resolution planning. What they're looking to do is focus on operational risk that's most relevant to the FDIC. So they can go through and do a weekend sale of a large bank and operate the institution for a short period of time while they're trying to make that sale. Next is the FRB. And so the Fed had the first proposed rule under the Trump administration to reform bank stress testing, and this is modifying 12 CFR Part 225 and 238, which are modifications to the capital plan rule and the street capital buffer requirements. Comments are open until June 23rd on this. What we still don't know, and you heard Scott mention this earlier, for Regulation II on debit card interchange fees and routing, is whether the Fed is going to abandon this. It's been out there since 2023, but we need them to abandon that. And then there's also the Basel III capital rules. We expect that there will be delays in this because Barr really was leading the endgame efforts at the Fed. He resigned before the new administration. The OCC this month has been active. It issued two proposed rules. There's the interim final rule on bank mergers, and there's the request for information on community bank digitalization. The bank mergers, it's amending its final rule from 2024, and it's trying to restore a streamlined application process and expedited review for evaluating applications under the Bank Merger Act. As Scott mentioned earlier, we're seeing a lot faster approvals than we've historically seen. And it also rescinded its 2024 policy statement. And then with respect to the community bank digitalization, it's requesting several different areas of comments. And I think this is something that's, if you're a community bank, that's worth commenting on, because I think this administration will be more likely in these agencies to review comments that are submitted because there's a focus on making sure that the industry is not being burdened by new rules. Next, I'll turn it over to Ron.
Thank you, Kristen. Well, as I'm sure everyone is aware, the new administration has been engaged in making some reductions in the federal workforce, and that does not exclude the banking agencies, particularly the FDIC. Their hoping to cut up to 20% of the workforce, a total of which would be 1,250 employees. Already made significant cuts there. 500 workers accepted the deferred resignation offer that was offered by the Trump administration. 170 probationary employees were fired, and so far cuts amount to about 10% of the agency's workforce. OCC also not as affected as the FDIC, but there have been 140 employees that have accepted the deferred resignation buyout, and 76 probationary employees were terminated. FTC, far less affected, much smaller agency, at least a dozen probationary employees were terminated. Federal Reserve, really no impact, at least not yet. Of course, all of this doesn't come without criticism. Democratic senators, led by Senator Elizabeth Warren, sent a letter to the FDIC, particularly focused on the presence of DOJ at the FDIC and what they allege is DOJ's indiscriminate dismantling of government agencies. And they contend that will result or could result in an uptick in bank failures and inability of the agencies to manage the deposit insurance fund and ultimately cripple the fund as well as the banking system in general. The letter contends that the FDIC was already severely understaffed and unable to adequately execute its statutory obligations. There's some evidence of that. They point to the Inspector General report that cited staffing weaknesses as a top management and performance challenge last year. The Democratic senators requested a response to their letter by May 8th, and I'm sure that that's probably lost in the mail. Kristen, I'll turn it back to you.
Next, we wanted to talk a little bit about enforcement investigations and litigation. Scott had mentioned this earlier, included in the request to remove the guidance, but there was a lawsuit out there that was challenging Bill 32, which was the supervisory guidance on NSF fees. That lawsuit was dismissed in April. The court made a determination that the plaintiffs lacked standing and the bill was not a final rule under the APA. So that's unfortunate, but there's still opportunity for the agency to act. The FDIC also brought a lawsuit against 17 former executives and directors of Silicon Valley Bank related to their collapse in 2023. So we'll watch and monitor that. The FDIC also filed something to defend its right to use in-house proceedings for enforcement at the Seventh Circuit, trying to distinguish what they're doing from Jarkissi opinion that was issued earlier this year. And the FTC has brought two actions which are relevant to this group. They brought one against a rideshare company for deceptive billing and cancellation practices. And they also brought another action against a cash advance subscription service, stating that they were misleading consumers about amounts and timings of available cash advances and obstructing efforts to cancel subscriptions. And so that kind of ties back to, why we think they're not going to take any action for the click to cancel rule and continue to enforce that. I'll turn it back over to Scott.
Yeah, I'll be real brief on this, but we've seen both the OCC and the FDIC take action regarding examination for reputation risk. There has been opposition by financial institutions to OCC examination for reputation risk, believing that it allowed for Operation Choke Point scenarios, barring financial institutions from providing services to certain industries or certain companies. And there was a belief that it was a double counting of risk because, by and large, the regulators are already looking at activities and customers from a risk framework, and reputation risk could in fact double the risk assessment. The OCC issued a news release in March saying that the OCC examination process has always been rooted in ensuring appropriate risk management processes, not casting judgment on how a particular activity may fare with public opinion. and that the OCC has never used reputation risk as a catch-all justification for supervisory action. Focusing future examination activities on more transparent risk areas improves public confidence in the OCC's supervisory process. If you look on the OCC website, and especially look at all of the corporate activities bulletins, they all have been stamped or legend at the front to remove all references to reputation risk from it. The OCC did issue the bulletin removing references to reputation risk, as I mentioned, so you can see that online. And then the FDIC, in a letter to the House Subcommittee on Oversight and Investigations from the Committee on Financial Services, issued agreement with the comments they received that banking regulators should not use reputational risk as a basis for supervisory criticism. They acknowledged, in their opinion, that the use of reputation risk has been abused in the past and adds no value from a safety and soundness perspective as a standalone risk. The FDIC stated they conducted a review of all mentions of reputational risk or similar terms in regulation, guidance, exam manuals, and policy documents, and that they plan to eradicate the concept from their regulatory approach and are working on a rulemaking to ensure supervisors do not criticize activities or actions on the basis of reputational risk alone.
Next, we're going to talk a little bit about debanking and fair access. And so this is coming to us from Acting Comptroller of the Currency, Hood. And while he was speaking at the Consumer Bankers Association Live, he had stated that the OCC really wasn't going to tolerate debanking of entire categories of customer accounts without having an individualized risk assessment. He wants banks to evaluate businesses based on objective criteria rather than having just categorical exclusions of like, we're not going to bank these types of people. He stated that he believed that customers engaging in lawful activities should have access to financial services, including those that are engaging in digital assets. He did not say whether he wanted to revive what was known as the fair access rule that was finalized at the end of the first Trump administration. But we'll have to wait and see what happens with that. And we've also heard some rumblings that Republican lawmakers are exploring reinstitution a version of the fair access rule through legislation. But we'll have to monitor and see where that goes. Next, we wanted to talk a little bit about fair lending enforcement. And we've been trying to determine what's going to happen at the agencies in terms of fair lending based on some of the things that have happened. If you've been following the CFPB, you saw that they've been backing down some of their cases and enforcement actions related to fair lending. It seems like there's going to be a shift towards looking at disparate treatment, but maybe moving away from some of the disparate impact theories that we've seen. In February, we saw a memo from the new AG, Pamela Bondi, where she was directing the divisions to narrow the use of disparate impact theories that effectively require the use of race or sex-based preferences and emphasize that statistical disparities alone do not automatically constitute unlawful discrimination. And essentially what she said, it was her Civil Rights Division will investigate, eliminate, and penalize illegal DEI, DEIA preferences, mandates, policies, programs, activities in the private sector and educational institutions that are receiving federal funds. And what she further said is they're looking at programs, initiative, and policies that discriminate, exclude, or divide individuals based on race or sex, but it does not prohibit any sort of educational, cultural, or historical or observances, like such as Black History Month or similar type events that are going to celebrate diversity or recognize historical contributions and promote awareness. And she quoted from the recent Supreme Court case, Students for Fair Admissions versus Harvard, that eliminating racial discrimination means eliminating all of it, and that educational agencies, colleges, and universities that receive federal funds may not treat some students worse than others, in part because of race. And then there was also an executive order on restoring equality of opportunity in meritocracy that aimed to eliminate the disparate impact theory of discrimination to the maximum extent possible. And that what that order had said was that disparate impact liability is wholly inconsistent with the Constitution, that it was threatening the commitment to the merit and equality of opportunity that forms the foundation of the American dream. And obviously, this is a complete change from what we saw under the Biden administration's combating redlining initiative that was announced by the Attorney General back in October of 21. Because during the former administration, the bank regulators made a record number of referrals to the Department of Justice based on redlining accusations. And in a lot of those cases, the disparate impact was applied and was the principal basis for the allegations. And it was based on activity that happened prior to the Biden administration taking office. And, why that is important is now, even though now there's a shift in policy to eliminate the disparate impact liability, the problem is the next administration could have a different focus, and they could look at prior activity and it could be back in play for any sort of enforcement. And because of this, I wouldn't say go out and change your compliance related to disparate impact, because you just, without some sort of legislation being passed, I think you should be wary of making substantial changes to your CMS, just not knowing how this will be handled and whether there will be a look back with future administrations. But as of right now, they are going to deprioritize the enforcement of disparate impact liability, but I guess we'll see what happens under a new administration. And then additionally, HUD filed a status report in one of their cases, and they said during this case that they still have the intent to reconsider its disparate impact rule, and the process is still ongoing. So more to come about that. But again, we're not recommending that you rush out and change policies and procedures at this point. Additionally, there was 2 more executive orders that could have impact on fair lending, and that executive order 14148, this order rescinded several Biden-era executive orders and presidential memorandums, including the order to prevent and combat discrimination on the basis of gender identity or sexual orientation. We also have Executive Order 14168, and that order was to defend women from gender ideology extremism and restoring biological truth. And that what they said they were trying to do in the background for that was to address efforts that permit men to self-identify as women and gain access to intimate single-sex spaces and activities designed for women, and have access to women's domestic abuse shelters and to women's workplace showers. It was the policy of the United States to recognize 2 sexes, male and female. And so we're going to wait and see kind of how these play out. But based on these things in the administration, we do think that there may be less fair lending enforcement going forward. And with that, I'll turn it over to Ron to talk about some federal preemption.
Thank you, Kristen. So I guess there isn't a whole lot going on with respect to preemption at the agencies. The biggest question probably is pertaining to national bank preemption, and that's whether the OCC and the FDIC could issue, not pertaining to national bank preemption, but preemption generally, rules, interpretations about its views on preemption. But with respect to national bank preemption, you're probably aware that there was last year the Supreme Court unanimous U.S. Supreme Court case Cantero, which was an appeal from the Second Circuit interpreting New York law, and then also courts of appeals cases in both the Ninth Circuit, that's the Kivett case interpreting California law, and the Conti case in the First Circuit, that's interpreting Rhode Island law. They all incidentally deal with whether or not state laws requiring payment of interest on escrow accounts are preempted under the National Bank Act. We still don't know the answer to that question. The Supreme Court took up that case last year, despite both sides' request for a bright line test on determining when preemption applies. The Supreme Court, not surprisingly, declined to apply a bright line test and kicked it back to, in the Cantero case, the Second Circuit, telling it to apply the Barnett Bank standard, which is the standard that was codified in the Dodd-Frank Act that requires courts to look at whether a state law prevents or significantly interferes with a national bank's exercise of its powers. The OCC had regulations, or does still have regulations, that interpret that, what it means to significantly interfere with the national bank's exercise of its powers. We largely believe that the Supreme Court's decision in Cantero effectively created a sea change in how preemption is viewed, with the standard to look at nuanced analysis of the Barnett Bank standard and cases that interpreting Barnett to determine whether or not that preemption standard of significantly interferes with the national bank's exercises of its powers has been met. The cases are in the courts of appeals, all three of them, Cantero, Kivett, and Conti. They're still there. Don't know how they're going to come out. I'd be surprised if the OCC issues any regulations that would try to further interpret the standard. In fact, last week, the Council of State Bank Supervisors sent a letter to Acting Director or Acting Comptroller Hood asking him to rescind their current rules on that. Probably not likely to happen either. I think they'll probably let the courts deal with this for a while. The other development regarding preemption is with respect to the Colorado DIDMCA opt-out. The Depository Institutions Deregulation and Monetary Control Act of 1980 allows states to opt out of federal interest rate preemption. The federal interest rate preemption is the authority that gives state banks the ability to export rates from their home or interstate branch states to loans to residents in other states. Colorado, DIDMCA, the law gave states the ability to opt out of that. Colorado did that in 2023. Of course, there is dispute over the effect of that. Really relates to where the loan is made, whether, as the state of Colorado argues, if the borrower is a resident of Colorado, then under its theory, the loan is made in Colorado. Under the bank's theory, it's made generally where the bank performs significant lending functions, in other words, in the bank's location. The FDIC had, under the previous administration, filed an amicus brief that would support Colorado's position in that litigation, contending that a loan is made where the borrower is located, as well as where the bank is located, but where the borrower is located. Incidentally, that would be contrary to the position it took in an amicus brief filed in 1992 in another case. No mention of the reversal in policy that when they did that. When the new administration came in, the FDIC withdrew its amicus brief in in that Colorado litigation, which is now before the 10th Circuit on appeal of the preliminary injunction. The FDIC did not, however, file an amicus brief in support of the bank's position. So it's clear that the FDIC no longer supports the state's position, but has not gone so far as to do anything in support of the banks. Probably the potential that the FDIC could issue a rule interpreting that, probably unlikely in the near future anyhow, but we're watching that. With that, I'll turn it back over to you, Kristen, and talk about Enforcement Act.
Yeah, we're going to talk in the remaining time about some of the other executive orders. Executive Order 14192. Essentially what this executive order was doing was capping regulations that could be proposed. And if you were going to propose new regulations, that you had to identify 10 regulations to be repealed. It'll be interesting to see how this plays out. But essentially, any new incremental costs that were associated with the new regulations should be offset by eliminating existing costs with other regulations that were going to be repealed. Yet to see how that's going to come into play. But the former in-house banking counsel in me gets excited because a lot of these proposed regulations that we've seen have a lot of costs operationally that don't seem to be accounted for in some of the rulemaking. Please confirm you're still listening. And in response to the executive order, the DOJ had issued an anti-competitive regulations task force. They are looking for comments by May 26th. They're looking for information from the public about laws and regulations that make it more difficult for businesses to compete, particularly housing, transportation, food and agriculture, healthcare, and energy. They have a task force page that they've set, and on May 5th, the FTC and DOJ issued a joint letter to the heads of the agencies directing them to create a list of anti-competitive regulations that they have that are either reducing competition, entrepreneurship, and innovation. Next, we have Executive Order 14215. This executive order was looking to have accountability for the agencies, and President Trump issued this order saying that these independent agencies have exercised enormous power over the American people without the presidential oversight. He specifically mentioned agencies by name, the FTC, FCC, SEC, but again, used a broader definition of agency, which could include the financial regulators such as the FDIC, the OCC, CFPB, and NCUA. And he is looking for the White House's review of draft regulations and consulting with the White House on priorities and strategic plans, and that the White House would be involved in setting forth the agency's performance standards and looking at the tax dollars that was apportioned to each of the agencies to make sure it was well spent. The next thing I wanted to talk about is the OMB issued guidance on this executive order, 142215. They have an implementation timeline for when they expect you to be in compliance. And so you're supposed to be in compliance with the executive order no later than April 21. And the guidance that they issued seeks to ensure that the agencies, when they're creating new regulations, that they are identifying the problem that they're seeking to address and its significance, assessing whether the existing regulations created or contributed to the problem that the new regulation is trying to correct, identify and assess whether there's available alternatives to the regulatory action, choose the regulatory approach when it's necessary, and finding the most cost-effective approach to achieve that objective, that's going to also safeguard innovation, looking at the cost and benefits of the regulatory action, and making sure that the benefits are really going to justify the cost of implementation, that the decisions are going to be based on scientific, technical, economic, and other information that are needed for the consequences of the actions that we're seeking, and incorporating the cost and benefits, that we're preventing the adoption of inconsistent, incompatible, or duplicative regulations, that we're tailoring any regulatory action to minimize any sort of burden to society, individuals, businesses, or other entities, and that the drafts are simple, plain language actions that will minimize uncertainty and reduce litigation risk. Next, we have Executive Order 14219, and what that was looking at is requiring the review of regulations for consistency with law and administrative policy. And this is where he was giving the OMB and DOJ, and in some cases the Attorney General, 60 days to identify regulations that have undue burdens on small businesses, are based on unlawful delegations of legislative power, that include matters of social, political, or economic significance, that are not authorized by clear statutory authority, impose significant costs on private industries and people that are not outweighed by public benefits, impose burdens on small businesses, and harm the national interest as well. So I think, again, there's a whole lot of new executive orders that we're going to have to see how they really play out with some of these regulatory agencies. And lastly, there's an order on strategic Bitcoin reserve. This is the original cryptocurrency. And what they like about this is that it caps the total supply of the Bitcoin to 21 million coins. And the system has never really been hacked. What they're trying to do is create a Bitcoin reserve within the government and have a stockpile of these assets that they're taking as well. And the final executive order is, again, I referenced this earlier, this is combating unfair practices in the live entertainment market. And this is why we said we didn't think the FTC rule would go away. They want to make sure that competition laws are enforced in the concert and entertainment industries, the laws that are in place, and making sure that we're preventing unfair and deceptive and anti-competitive conduct in some of the secondary ticket sales market. And with that, I'll turn it back over to Alan.
To make sure you don't miss our future episodes, subscribe to our show on your favorite podcast platform, be it Apple Podcasts, YouTube, Spotify, or wherever you listen. And don't forget to check out our blog, consumerfinancemonitor.com, for daily insights on the financial services industry. And if you have any questions or suggestions for our show, please email us at podcast, singular podcast, @ballardspire.com. And stay tuned each Thursday for a new episode of our show. Thank you for listening and have a good day.